What is up, YouTube? Matt McKeever here again with Kasey Wong. So we're coming to you from his Toronto office, and we really got a treat for you in today's video. Kasey's actually broken down a spreadsheet on exactly what's his property at St. Catharines, right? What that looks like. So what does it look like as far as what the seller provides us versus kind of reality? 2 lines into your spreadsheet, we've got garbage disposal. They hadn't budgeted anything.
Exactly. So a lot of the times sellers will give you the information, but it's not full information, so you actually have to go dig a little bit deeper. So this property, St. Catharines, is a 40-unit building. We bought it for $5.3 million, not 5.2, so it's $5.3 million. Okay, so don't forget that 2%. It makes a huge difference when you're scaling to something larger.
What is up, YouTube? We're back with Kasey Wong. We're in Toronto. We're sitting down at Kasey's office, and in today's video, he's going to break down for us exactly the way him and his wife analyze real estate investment opportunities. One thing you're going to notice, this isn't a super complicated spreadsheet. They're not focused on things like IRR, that's the internal rate of return. They're really quite simple and basic calculations that Kasey's implementing in order to decide whether a deal is truly a deal or a dud. I'm really excited by this video. I know you guys have been wanting it, so I'm not going to take up any more of your time. Just smash that like button, hit the subscribe button if you're new to my channel, and let's dive into a number crunch with Kasey Wong. What is up, YouTube? Matt McKeever here again with Kasey Wong. So we're coming to you from his Toronto office, and we really got a treat for you in today's video. Kasey's actually broken down a spreadsheet on exactly what's his property at St. Catharines, right? What that looks like. So I think let's just dive right into it.
Sure.
So if you don't mind first, Kasey, just kind of walk us through what does it look like as far as what the seller provides us versus kind of reality. Because right off the bat, I can see like there's some differences, and like there's a lot of things that often get forgotten, right? That's so right. For example, you know, 2 lines into your spreadsheet, we've got garbage disposal. They hadn't budgeted anything.
Exactly. So a lot of the times sellers will give you the information, but it's not full information, so you actually have to go dig a little bit deeper. So this property, St. Catharines, is a 40-unit building. We bought it for $5.3 million, not 5.2, so it's $5.3 million. Now, sometimes the seller will give you information. It's not going to be the full information. It could be 6 months worth of information. It could be kind of throw it off, and they give you 2 years information. So you got to take a look at what's apples to apples and what you're comparing another 40-unit building to another 40-unit building. So you can compare this with a 10-unit with a 10, but you can't go 10 with a 40 or 40 with a 100. So in this particular case, when you take a look at this, let's say looking up here at the numbers, we go, the first line that says percent increase at 2%. So we're looking at the rent. Okay, we'll dive deep into the expenses, but just on the income side, you're looking at rent, laundry, parking, it could be storage units, things like that. And then with a 2% increase in Toronto, in Ontario, you're probably looking at a regular 2% increase. And that's significant. You have to increase that on your anniversary date on a regular basis. So you're gonna give that N1, N1, N1 each and every year. Make sure that it's 90 days prior to the first of that month, but you're gonna provide that to them. Okay, so don't forget that 2%. It makes a huge difference when you're scaling to something larger.
Especially over time. Like I find so many investors are like, oh, what's the point for a 1.8% increase? But it's like, well, if you don't do it this year, then if you don't do it next year, like again, it starts compounding, right, with each one. Exactly.
So let's just say on my 65 unit, my gross rent is now $70,000. Let's say it's $70,000, about 72, but let's say $70,000 on 2%. On 1%, what is that per month? It's $700, right? 1%, double that, that's $1,400, right? So $1,400 per month. That's significant now, right? So you just do the quick math on that. So $1,400 each and every month on one holding, okay? Then you have multiple holdings. So $1,400 each and every month. Again, the following year, that's gonna increase as well. So again, Matt was saying about increasing it on a regular basis and don't miss, definitely do that. Okay, so let's take a look at the top line. It's going to be a 2% increase each and every year. Put that into it. Put that into your equation. So that's going to be your income level, and then all those other types of income that you can basically charge. You're going to charge, okay?
And Kasey, do you have like a rule of thumb for like what those other auxiliary incomes should look like? For example, I know when I'm looking at a lot of like large multifamily buildings, usually the seller hasn't recorded or put into his tax return what his laundry income. And so usually he's like, nudge, nudge, I make $500 a month.
Right.
Do you have like a rule of thumb for what you'd expect, like say a 40 unit building to earn in laundry?
Like a 40 unit, we go by units first. So you're probably going to be spending each, I believe it's, let me do a quick calculation, but we're looking at about $40 to $50 per unit per month, okay? So even if you do $40 at 65 units, okay, because some people are not going to do the laundry.
Yeah.
So it's at 26, let's say 2,600 per month, and I usually times that by about, yeah, that makes sense, by 75%. That makes sense, okay?
Yeah.
So $40 times 65 units or 40 units, let's do this one in particular, $40 times 40 units, which is about $1,600. And I'll multiply that by 75%, okay, or 0.75. Because I say that 25% of those current out of the 40 will go somewhere else. So I'm guesstimating about $1,200 each and every month for the laundry income.
Yeah.
Okay. And then if you have to increase it, you're going to increase it in wintertime. Makes sense? But you're not going to, obviously it makes sense, right? If you're going to do any kind of increase, you're going to increase it, let's say in December.
Yeah.
Right. So people in Christmas.
People don't want to travel
in the wintertime, right?
Yeah, go off
So
site.
exactly. So when we're going to increase it, sometimes you do have to, right? Because a lot of the expenses on utilities, on gas and water, electricity, who's charging you that? They automatically, utility companies get that increase anyways. So landlords can't afford to bang back. Like I don't have like deep pockets. Some of these properties don't make a lot of money and they have to do that, right? And some of these tenants probably will gripe and say, you know what, you're making so much money or whatever, and look at you, all you do, like I get all these, like people are always on me saying that, oh, you're just hungry for money, you're a bad landlord. But the reality is that this margin of real estate, of being a property manager, of being a landlord, the margins are slim, okay? If not, it could be negative, right?
Yeah.
So you have to be able to watch that bottom line, and you have to do the increases on a regular basis. So that's your top line. You have your main income, which is your rent, and then you have your sort of your secondary type of income on a regular basis, and then you just have to increase it, and just be smart when you do it.
Yeah.
Right? So let's move on. So on that, if you're taking a look at this, so we project numbers by the seller and then by 5 years out. When we do that, we have a 40% sort of an expense ratio of on gross income. So we have that and we say, hey, this is what is that going to be? Now, property tax. The first line is basically property tax. It's pretty easy. You get the information from the city. You're going to compare that. Sometimes on the macro level, you're going to compare a London, a St. Catharines, to a Barrie, to a Hamilton, right? When we took a look at, let's say way back, we'll have to take a look at now, but Hamilton and Orangeville was actually quite expensive.
Oh, okay.
Okay, so I'm not sure relative to other cities now. St. Catharines seems to be expensive as well, okay, relative to our core sort of holdings in the Kitchener, Waterloo, Cambridge area, the KWC area. It seems to be a little bit more expensive. So you know what? How can you offset that? Is the rent going to be a little bit higher? And actually the rent is quite strong. St. Catharines is a very, very strong market. And then subsequent to that is that St. Catharines, then you have a Welland, Niagara Falls, like you have other areas that's going to be quite strong as well. Just for the fact that if you have one area that has higher rent, the subsequent surrounding areas will be strong as well. But you have to take a look at growth, like GDP, how many companies are moving in, what's the employment sort of level or unemployment level, see what that area, because you want to buy in a growing location. If you're buying in a location that doesn't have that, be very worried about what could happen, or your growth as in your appreciation of that underlying asset. It could be very, very stagnant. Okay. Yeah. There's nothing wrong with it. Some people buy cash flow and just hold cash flowing properties, right? But your underlying asset, the appreciation could be very, very flat. I like both. I like to have a growing location. I don't like to buy the primary, like the Toronto, but the secondary market, the outlining 1 hour away, it's a very, very strong market.
Cashflow Tribe.
What is up, YouTube? Matt McKeever here with Ben Humble CEO. And if you guys haven't been paying attention to what we're up to, we've created a community called Cashflow Tribe. We're really focused on, well, let's just be honest, getting you guys results. I've been doing this YouTube channel for 3+ years. I know there's a ton of people that have only ever watched my YouTube channel, but never submitted an offer, never bought a property, never leveled up their personal finances. So with Cashflow Tribe, Ben and myself, we're really focused on changing that. So this is all about getting you results. In fact, our company mission is that engaged Cashflow Tribe members will do 3 deals in their first 12 months and at least make $30,000. That's it. It's that simple. I do weekly training for Cashflow Tribe members. We've got a private Facebook group. I actually give priority access, and Ben gives priority access too, to all of our private deals. So all the wholesale deals that I'm doing in London, Kitchener, Windsor, anywhere and everywhere in between, those all go to Cashflow Tribe members first. And it turns out they're a pretty thirsty bunch because we're not selling our deals anymore to essentially anyone that's not a Cashflow Tribe member. If you guys want to check it out, Ben and I, we're going to do a special promo for my YouTube fans. You're going to get 7 days absolutely free. So you can join Cashflow Tribe 7 days. Yeah, we need your credit card information, but you will not be billed until the 8th day. So you can just literally binge the 20+ hours of on-demand training and content we already have there. Go check it out, cashflowtribecanada.com, or we'll actually just throw a link in the video description down below, and I'll pin a comment for you guys. Check out Cashflow Tribe if you haven't, and let's make 2020 your year.
Cashflow Tribe.
Okay.
Yeah, and so I just want to hit home on that one tip Kasey had at the start there for property taxes. It really is important that we reach out to the city. I know earlier this week I'm looking at a 30-unit apartment building in London, and somehow the seller forgot to include 50% of the property taxes in his estimated numbers. So he gave me $12,000 a year for a 30-unit apartment building. I was like, this doesn't make sense. I was like, this doesn't feel right. So I had my realtor reach out to the city. They pulled it up, found out it was actually $24,000. $12,000 makes a huge difference in my bottom line.
Sometimes it's a mistake. Like you don't know what it is. It could be a mistake. Like give the benefit of the doubt to the seller and just take a look at it. But if there's a red flag and it doesn't seem right, from $12,000 to $24,000, that makes a huge difference. If you make that calculation error, that's potentially to your investors or to yourself. Like who's going to cough up $12,000 each and every year, right? It's $1,000 a month. Yeah. So let's take a look at garbage disposal. There's no numbers. So we actually have to take a look at garbage disposal, take a look at vendors that provide that, specific companies. At $7,000 to about, let's say about $10,000, it makes sense. When we do garbage disposal, you may have to up it a little bit because you're gonna have special pickups. So you have to think about, okay, well, this is on a regular monthly basis. You may have to bump it up. It could be furniture, people moving out, things like that. So take a look at what you need. And also labor costs as well, because you're gonna have to move those things out. You can call 1-800-GOT-JUNK and a snap of a finger, get somebody in, but put that into your calculation. So what that means is that, okay, well, on that turnover, I'm gonna have a certain amount of turnover. Let's just say I'm gonna have 20% turnover per year, and that 20% of the 40 units, let's say it's 8 units per year, 8 units, let's say it's gonna cost me about $1,000. Put that into your calculation, okay? And then just say you're going to have 10%, okay? Whatever that is, so you're gonna have 4 units, 4 units, 4 units, each and every year turning over. So you're gonna put that $4,000 into the calculation. So make sure that you know exactly what you're gonna go into. And sometimes you have dumping charges people just dumping. Yeah. So I had that as well. People just coming in on your property and just dumping. You can catch some people. I've done that. Essentially driving around because I have the person's license plate. I go to the bylaw. You have to actually sort of police that as an owner. You can get your staff to do it. Some of my staff don't like to do it just for the or my superintendents, they don't like to do that because they're not confrontational. It's confrontational. You don't want to do that, but I don't mind doing that. I am, I don't know, a little confrontation.
It's costing you money.
It's costing me money, exactly. So for my investors, they appreciate that, and I just don't like people dropping things off and dumping things on your property. So I had a lot of stories about everything, everything from tenants to people damaging, like everything. So make sure that you put that into your calculation for garbage disposal. Now, electricity, water, and gas. Let me hit upon, these are the utilities that you have be worried about. So the current seller gave the electricity about $22,523, right? So he gave me a whole bunch of yearly expenses, and you verify it, making sure it's good, it's correct, and it seems like it is. Now we dropped it down to $13,514. For that, we already actually have a separate, we can separate meter the hydro, and most apartment buildings would actually do that.
Yeah.
They would actually offload just the hydro. You can offload everything if you really wanted to, but then the tenants are smart. They'll say, okay, well, what am I doing here? What am I paying? If I'm paying for everything, my rents would have to drop.
Yeah.
Right. And then if you do separate meters and all, there's an administrative cost as well. To the company that we're using, it's called Wise. They're going to have to get paid somehow. So it really bumps the bottom line for that tenant. I'd rather be apples to apples with with the tenant and the prospective tenants. So if they're just offloading, most landlords, property managers is offloading specifically hydro.
Yeah.
Just do that. Like, I don't mind doing that because it keeps that competition in a way, or that ad, when they're looking at it, that piece of unit, that property, pretty consistent.
It makes your unit very comparable to the competition.
Exactly. So
And-
you just want,
And I think another big reason that landlords usually just offload hydro is because that's often the only one that's already separately metered, right?
That's right.
So to be able to separately meter the gas or the water is going to be expensive, and
Exactly.
for gas it's probably going to be impossible unless there's an individual heating unit for each apartment.
Exactly. I think we touched upon that as well for the
Yeah.
heating units and all. So that's what I do for the electricity. And make sure you get 12 months or even 24 months to see if you can get any kind of variances, right? So why would 1 year be more than the other? Maybe if you're paying for electricity, is there a big spike because everybody has their AC cranked on and so on and so forth. So you have to know exactly what you're doing. Water is pretty standard. You can do a variance report for that on a monthly basis. So we try to do that. So we know if there's a running toilet, if there's shower heads or taps that need to get changed, aerators, things like that. So you can delve deep into these things and find out exactly how to save and what to do. If the expenses are high, why is it high? How to decrease it, because that affects your bottom line. Okay, gas is important. Sometimes the owner accidentally gives you, only 6 months, and you're buying it, let's say in September, October, November. It's kind of weird. It's like, okay, well, I only have 6 months, and that's it, right? But the thing is that for gas, it's a big point because of heating. Here in Ontario,
Yeah.
our heating costs, the most expensive months are basically the 6 months from November, a little bit of October, but November, December, January, February, March, April. Those 6 months, if not 5, 6 months are going to be high. So if he tries to say, here's the 6 months and that's it and runs, no, you want to see a full year, if not 2 years. Okay, so you want to be able to break it down. And if you're just using 6 months and you say, I'm just going to double it, that's going to be a huge mistake because now you're underestimating your expense line, right? When that, obviously, then that overinflates your property, your NOI.
Yeah.
Now it overinflates the value of your asset, of your building. So again, your utilities can tell you a lot, and you have to dig. You have to dig, right? Insurance. Insurance is pretty easy, but you're going to get your broker. It's that go and take a look. They have to look at the property, and you have to insure it properly. So if it's a 40 unit, regular building, you can insure it as a 40 unit. You can have the replacement costs. You're going to have the rent covered. Actually, my hairdresser. I've been talking to her about for 12 years. Okay, about real estate. Every couple of weeks, I'm like talking about real estate because that's what I like to talk about. But now she goes, oh, I want to invest in real estate now. It's only 12 years, my goodness, 12 years. She's probably going to be watching this. I told her about YouTube and real estate, but like, I go, I know, you want to be safe, right?
Yeah.
And he goes, yeah, I want to be safe, and it takes me time. I go, safe and time is completely opposite. You can be safe, but don't take that much time, okay? So I was telling her about the story goes here. You think I'm digressing, but I'm not. So she's saying, oh, what happens if there's a fire? It's not a big deal. Insurance cover everything. They will replace a building, cover all your rent, and give you a new building. You don't want to know that you don't have enough coverage, and you're sitting up, basically, you're walking in knee-deep water, right? Or there's a fire, and now you say you don't have coverage. So make sure you get that done properly. At the beginning, I did that. I did the painting. I changed some toilets. My sewer line broke. I was there. My contractor's trying to figure it out. Like, you get black water splashing up on you, just close your mouth, okay? Whatever. Respect that. Like, respect your investors' money, right? They want to know that their money is safe, because you know what, they want to retire too.
Thanks again to Kasey for taking the time to break down the numbers on just this example property. Now, to be honest with you guys, these days for me and Kasey, this is just kind of standard operating procedure stuff. So we don't even often think of making videos like this. So if you want more videos like this, what you need to do is jump in that comment section and let Kasey and me know that you want us to do more number deep dives, because we could crank these out all day, but only if they're providing you value. So if they are, smash that like button, hit the subscribe button if you're new to my channel, and next video, we'll have more Kasey.